Hello, this is Jordan, and this is your precious metals video market update. This video is being recorded on the afternoon of Monday, November 12th, 2018. Thank you so much for joining me today. In this video, I'm going to discuss the current outlook for gold stocks. And the current outlook for gold stocks, unfortunately, is very bearish. Here we have the daily line charts of GDX at the top and GDXJ at the bottom. And today we can see that both these markets broke below their recoveries or fledgling uptrends since September. Now, as we know, both markets were consolidating since the beginning of 2017. That lasted until almost the end of this past summer. But since July, the miners began what you could say is an impulsive leg down. So a real trending move to the downside. And that move broke the support of the consolidation. So that was a technical breakdown. And so that move continued down, but then the miners became extremely oversold, and we're going to have at least a relief rally, and that's what we got. And the rally went back to previous support, which is current resistance. So that happens a lot when you have a move that breaks a key level. Usually at some point you'll get a retest of that break. So this weak rally that we've had for the last couple months was a retest of the break. And what we're seeing now, especially in the last couple days, it looks to me like a resumption of the downtrend. This is the downtrend that really began in July is reasserting itself. And so that's very bearish. And I'm looking for potentially by year end we could see $16 in GDX and 22.5 for GDXJ. I mean, that sounds really bearish for GDXJ, but if you go back to the middle of 2017, you can see those blue half circles I drew there for the GDXJ peaks. I mean, if you look at the September peak around 37.5 and then the support line at 30, breaking below that, I mean, that's 7.5 points. So that gives you a measured downside target of 22.5. So there's just nothing good I'm seeing here. This is really bearish, and there's a lot more downside. This move could just be getting started. And here's another reason when I say nothing looks good and it looks bearish. This is GDX at the top, and we can clearly see that thing I discussed in the last slide where the market broke below the support, and it's retesting it. So it retested it by rallying back to 20 or a little bit above there. But at the bottom, we have the advanced decline line for GDX. And the advanced decline line it's a breadth indicator, but it's really the best leading indicator out there. So that tells you about participation and what percentage of that market is going up or down, essentially. Because when a market is strongest, you basically have 95% or 100% of that market is rising. The stocks in that market, all of them are rising. And when it's weakest, all of the stocks are falling, or the vast majority of the stocks are falling. And so that tends to lead the market itself. And we can see a bullish example of that at the end of 2015, early 2016. The GDX advanced decline line made a positive divergence, and then it exploded higher along with the market. So it confirmed that move. Now, the weak recovery that we've had the last couple months, look what happened. The advanced decline line barely did anything. There's a negative divergence there. And even in the last week or so, the advanced decline line made a lower low. So it broke below its September low. I mean, that was a week ago. And the data hasn't updated yet today. So this is going to look even worse after today. But that's well below its September low. And GDX still hasn't come down to its September low. In the low 17s, I think. So this is, there's no way around this. This is just very, very bearish for GDX. And I expect GDX, over the coming days and weeks will follow to the downside. So again, this is just very bullish, or excuse me, very bearish. Okay, and we've obviously seen a devastating bear market in precious metals. The companies, we had the big rally in 2016. Their parts of 2017 were pretty good until that, until the breakdown we got this past summer. Well, that's 2018. But one thing to keep in mind is that gold stocks, during major bottoms for the sector, oftentimes they crash into that low. And I'm not trying to be extremist saying that, but that's really how to describe it. And at the bottom here, we have the GDM index. It's a weekly chart. I should have put a daily chart on there. But so GDM has had severe, well, I'm just using GDM. You can use the Huey, which looks even worse. But gold stocks into these major lows at the end of 2000, the end of 2008, in the middle to the end of summer 2015, they basically had severe downside moves into those lows. Now, I know in 2015 it consolidated for 5 or 6 months before the market took off. So technically it didn't crash into that low. But if you're looking at the senior gold stocks, they did bottom in summer 2015, like the real biggest, 3 or 5 ones. So they did crash into that low. But anyway, the point is we can't sit here and think, oh, well, the market's already gone down enough. There's not that many sellers left. It's not going to go down that much more. I'll just, hold on to my losers. They'll turn around. No, you can't think like that. This has potential to get much worse. And so this crash move to the downside in the sector into a major low, rather, for this coming major low that we're probably going to see in 2019, that move began. It looks like it began in July, August. That was the beginning of this crash move. And so that could last several more months, maybe even 4, 5, 6 more months. So the huge decline really started in the summer, and now it looks like it's just starting to continue again. Okay, now let's talk about the U.S. dollar, which is back in a bull market. It's obviously driving a lot of what's going on in precious metals. This is the weekly chart of the dollar. It's not updated yet for today. The dollar closed at 97.50, I believe, so a nice move higher for the dollar today. It would look even stronger with that data. But over the past 5 months, the dollar index really was consolidating around 95 to 96. It had traded at 94 at times. It had this strong move up to 94, 95. And again, for about 5 months, it's been consolidating from 94 to 96. It's been battling the long-term moving averages. Look at this band of moving averages. Go back to 2008 to 2014, and we can see how it provided resistance at times, especially at the end of 2010, and then it provided support end of 2012, late 2013, early 2014, before the dollar really took off. So the dollar in recent months was battling those moving averages. Now it's cleared them, it's above them, and there's a measured upside target of 102. There's resistance at 99 to 100, and really what we should look for in the dollar is more strength, higher highs, and eventually at some point that will force the Fed to stop hiking, and that will be bullish for precious metals. However, it's way too soon to say that. Does that happen if the dollar goes above 100, maybe above 104? My guess would probably be, and it's just a guess, I'd say, yeah, when the dollar goes above 104, maybe it gets to 110. That's probably the point in time when it could really force the Fed to stop. And then a stronger dollar at that point would be bullish for precious metals, because the stronger dollar is going to create lots of problems in the world. We have the dollar-denominated debt in the rest of the world. Their markets have already sold off. Their economies look like they're slowing down towards recession. All that stuff happens. A stronger dollar makes it worse, and eventually that comes back to the U.S. and hurts the U.S., and that's when it forces the Fed to shift its policy, which is bullish for precious metals. But again, we're talking about what could happen over the next 6, 9, 12 months. Over the next couple months, the reality is the dollar's probably going to move higher. Precious metals are probably going to move lower. But look, this is something that has to happen for us to get a major turn in precious metals. We need to see a stronger dollar, a much stronger dollar. So short term, it's painful, but long term, it will be a good thing to get our sector turned around into a bull market. Now, I mentioned this in my last video, and this is something I've been talking about for almost 6 months now. All the research I've done over the last, looking at the last 60 years in gold stocks, most of the time, like the vast majority of the time, you want to buy gold stocks when the Fed funds rate peaks, or when the Fed, after its last rate hike. that's when you want to buy gold stocks. Now, this doesn't work 100% of the time. Obviously, nothing always works always. There's points in the 1970s, and there's a few other points where when the Fed starts hiking, gold stocks have a big move. That was true at the end of 2015, but of course it didn't last. But looking at all the conditions that we have right now, and looking at history, I am extremely confident that when the Fed stops hiking after its last hike, that's when you'll see the bottom in precious metals. And the data here is really powerful. And when exactly does the move start? Well, based on the data, it's a median of 2 months after the last hike, an average of 1 month after the last hike. Obviously, we don't know. Maybe it's a week after the Fed's last hike. Maybe it's 3 months or 4 months. Maybe it's 2 weeks. We don't know. We'll just have to gauge conditions at the time. But look, I'm very, very confident that when the Fed stops hiking, that will be the start of the next bull market. And if they signal to the market they're going to shift to cuts, that's when you're going to see things really, really take off. Now, obviously, it's too soon for that, but maybe, who knows? Maybe it's 6 months away, maybe it's 12 months away, maybe it's 9 months away. I don't know, but I think it will be sometime next year. But again, where we are here and now, the outlook is still very bearish, and you have to protect yourself to the downside. This is something we successfully did in the summer. We bought the hedges in July and August. We did really well. Me and my subscribers trading the downside while holding high cash positions in a few of our favorite juniors. And we're doing the same thing now. We've been getting into the hedges in recent weeks. And in the last couple of days, we've been warning subscribers, if you haven't already gotten into the hedges, this is the time you have to get in, because these markets are looking like they could really fall apart over the coming weeks. And that being said, I consider you to, please consider following all my work at thedailygold.com and consider subscribing for my premium newsletter. It's only $149 for 6 months. Look, we're making money on the way down. We did it in the summer. We're doing it again now. I want to help you. I want to help my subscribers profit from the decline. And then we're going to have all this cash, and we could put it to work buying the stocks at the right time sometime next year. And when the Fed stops and they shift policy, that'll be the time that these juniors are going to double and triple within a couple months, after whenever the bottom is next year. So you can't be married to your stocks. You can't be emotional about it. Raise cash and hedge if you already haven't. Go to thedailygold.com/premium and subscribe. We're going to help you ride this thing out and get well positioned for the downside that's happening now, and then for the coming bull market when it should probably start sometime next year. Okay, thank you so much for watching the video. I really appreciate it, and I look forward to publishing another video update for you guys in the days and weeks ahead. Thank you.